Hello, friends. Today, in the series of Finance, Accounts, Taxation, and Corporate Law, we are going to talk about one of the very important concept of accounting. It's called depreciation accounting. So, here we will discuss what is depreciation accounting and what are the impacts of depreciation on financial statements and how depreciation accounting really works. So, as we know, depreciation accounting is a process of spreading the cost of a long-term assets over its useful life. It reflects the gradual loss of value. This is done by recording a depreciation expense each period, which reduces the asset book value on the balance sheet and impact the income statement by lowering the taxable income. The meaning of this language is, as we know, the asset gives benefits for foreseeable future for many years, but the amount that we have paid today and the benefit will accrue in future. So as we know, we are following the accrual basis of accounting. So incurring the entire expense in the P&L in one period, or the period in which we have capitalized the entire assets in one period, it will not serve the purpose. So what we do, we incur the capital expenditure in a period, and whatever the benefit that we accrue to the coming years, in proportionate amount of that assets, we keep on incurring every year in profit and loss account in the form of a depreciation, and the depreciation amount is deductible expense under the income tax act also. So now how we bifurcate, how we spread the cost of a long term assets over a period of time or over a period of life of the assets, there are many methods of depreciation. So one of them is straight line method of depreciation. Second is known as declining balance method. It is also known as written down value method. And third and last method is known as units of production method. So basically, how it works, how depreciation process works: spread cost. Instead of expensing the full cost of an asset in a year in which it was purchased, so depreciation allocates the cost of the assets over a period of time till its useful life. Second, why it is so happen, why we spread the cost over a period of time? Because of matching of revenue and expenses. So when we spread the cost over a period of time, it matches the revenue of a period with its cost. Third is reduce book value. So over a period of time, as depreciation we record in a profit and loss account, the value of an asset, that is cost value of an asset, gets decreases. So what would be its impact on the financial statement? Under the income statement, depreciation is recorded as an operating expense and which reduce the net income as well as the taxable profit. In balance sheet, the asset book value is reduced by the accumulated depreciation amount and it's no longer recorded at its original cost. Third, cash flow statement. Since depreciation is a non-cash expense, so it is added back to the net income to calculate the operating cash flow. Method we have already discussed. There are four methods. One is straight line method of depreciation, declining balance depreciation, that is known as written down value method. Third is called units of production method. Fourth is known as sum of the years digit method. So what is, why companies basically create depreciation or do depreciation accounting in their books of accounting? So there are two three main reasons behind it. One is wear and tear, second is obsolescence, third is passage of time. So wear and tear here means the physical deterioration of an asset due to its use. Obsolescence means the assets become outdated, out of fashion, and it less useful in the current scenario due to technology advancement or a market changes. And third is known as passage of time. even if it is not in use, the asset's value get decreased over a time, and we need to book the depreciation. So what is the journal entry in the books of accounts or regarding the depreciation is particular depreciation of a particular asset account debit to particular fixed asset, means depreciation account debit to asset. So this is the general entry that we pass, and ind AS 16 is applicable on depreciation accounting, and earlier it was in AS there was different standard that was used by for the depreciation accounting, and accordingly we calculate the depreciation. So my dear friends, depreciation is one of the important line item in the financial statement, as its impact both profit and loss account as well as the balance sheet. So it has a very important role for the purpose of financial statement preparation, its verification and audit, as well as its presentation disclosure. So everything need to be taken care of by the management while preparing the financial statement, and also it need to be properly examined and audited by the auditor using the various standard of auditing, and accordingly the auditor should report in its audit report about if in case of any misstatement arise due to depreciation or fixed asset. So hope my dear friends, the information that I have shared with you right now is very useful and insightful. In the coming video, maybe day after tomorrow, I will be coming with the new concept of finance, accounts, taxation, or a corporate law. Till then, stay good, stay blessed, and enjoy your day. Thank you very much.